Hey everyone, welcome back to Corporate Decoder, the place where we decode the cryptic language of corporate filings to find the hidden truths. Today we're diving into T. Rowe Price OHA Select Private Credit Fund's latest report to see just how their private credit investments are performing and if they're really as select as they sound. And let me tell you, there are some numbers in here that might make you want to grab your popcorn. Before we jump in, if you're tired of the corporate jargon and want clear, no-nonsense financial breakdowns, make sure you subscribe. Also, we've got a fantastic community over on Discord discussing these filings, so hop on in. The link is in the description. So T. Rowe Price OHA Select Private Credit Fund dropped this report on August 27, 2025. What's really important here is what they're telling us about their distributions to shareholders, which are basically the payments they make to people who own shares in the fund. They've broken these distributions down by different classes of shares like Class I, Class S, and Class D. They're telling us about the regular distributions and then these variable supplemental distributions. For Class I shares, the regular distribution 23 cents per share, and they had a variable supplemental that added another 3 cents, making the total net distribution 23 cents. Now for Class S shares, the regular distribution was also 20 cents, but here there was a shareholder servicing and distribution fee of about 1.9 cents. So the net regular distribution was a little less, around 18 cents. On top of that, they had that same 3 cent variable supplemental distribution, bringing the total net distribution for Class S shares to about 21 cents. And then we have Class D shares, again a 20 cent regular distribution, but this time the servicing fee was much smaller, just about half a cent. This means the net regular distribution of 42.4 cents. Adding the 3 cent supplemental, Class D shareholders got a total net distribution of about 22.4 cents. It's interesting to see how those fees can eat into the returns depending on the share class. These distributions are important because they show the cash the fund is generating and passing on to investors. These distributions that we just talked about are expected to be paid out or reinvested around September 30th. And importantly, they're going to shareholders who are on record as of August 29th. This means if you own shares on that specific day, you're eligible for this payout. The fund also has a plan where you can automatically reinvest these cash distributions back into more shares of the company, which can be a good way to grow your investment over time without having to actively manage it. Now let's talk about the value of the fund's assets. As of July 31st, the net asset value or NAV per share for each class of shares was $26.92. Think of NAV as the actual worth of each share after accounting for all the fund's assets and liabilities. The total value of their investment portfolio, which is basically all the loans and private credit investments they hold, was a hefty $2.56 billion. That's a lot of money tied up in private loans. And to fund all this, they had about $1.1 billion in debt. This is fairly common for investment funds as they use leverage to try and boost returns. What's key here is their debt to equity ratio, which came in at about 0.77 times. This ratio tells us how much debt a company is using relative to its shareholder equity. A lower number generally means less risk. A ratio of 0.77 means for every dollar of equity, they have about 77 cents of debt. This suggests they're not excessively leveraged, which is a positive sign for stability. Let's look at how much they've actually sold to investors. They're currently offering up to $2.55 billion in shares. As of the August 1st subscription date, they had issued a significant number of shares. For Class I shares, they issued over 45 million shares, bringing in about $125 billion. That's a huge chunk of their offering, showing strong demand for this particular class. Then Class S shares saw about 3.7 million shares issued, raising an $10.3 million. And Class D shares had almost 4 million shares issued, raising a little over $107 million. These figures tell us about their fundraising success and how much capital they've been able to bring in from investors for their private credit ventures. The fact that they're continuing to sell shares monthly suggests confidence in their ability to deploy that capital into new investments. This report is also tagged with interactive data, which is great for making sure all the numbers are clear and easily accessible for anyone digging into the filings. It means the key numbers are machine readable, which is crucial for transparency in financial markets nowadays. Now let's look at the bigger picture. T. Rowe Price OHA Select Private Credit Fund is essentially acting as a middleman, pooling money from investors to provide loans to private companies. These types of funds have become very popular because they can offer potentially higher yields than traditional bonds or public equities. However, private credit generally comes with higher risks because these loans are not publicly traded, and information about the borrowers can be less transparent. What we're seeing here is a fund that's actively raising capital and distributing those proceeds to its shareholders. The NIV per share remaining stable at almost $27 while the fund continues to grow its asset base is a good sign. The debt to equity ratio being under 1 also suggests a relatively conservative approach to leverage for a credit fund. The breakdown of distributions between the different share classes does highlight how fees and expenses can impact investor returns. Investors in Class S shares seem to be paying a bit more in servicing fees compared to Class D. This is something potential investors should always look at closely. Understanding the fee structure for each share class is critical. The substantial capital raised so far, particularly in Class I shares, indicates strong market appetite for this type of investment product. This fund is tapping into a growing market where companies that might not qualify for bank loans are seeking financing. The question for investors, though, is always about the quality of those underlying loans and how well the fund manager is navigating the risks inherent in private credit. Given it's a select private credit fund, one would expect a rigorous selection process for the loans they make. We don't have details on the loan performance here, only the distributions, which is a key piece of information missing for a full picture of their asset quality. Overall, the fund appears to be executing its strategy of raising capital and distributing income. The consistent regular dividend and the supplemental payments are attractive features. But investors need to remain aware of the risks associated with private credit, including potential illiquidity and credit defaults. For those invested, the key will be monitoring the quality of the underlying loan portfolio and ensuring the management team is effectively managing credit risk to sustain these distributions over the long term. The company direction seems focused on growth through continuous offering, which is positive if they can maintain asset quality. Alright, that's our breakdown of T. Rowe Price OHR Select Private Credit Fund's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.